Good morning, everybody. Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from TikToker. It looks like a Christmas tree, the radar screen this morning. We are showing a lot of activity here across the board, from stocks to commodities, metals, energies, pretty much across the board. Focusing on what we do best here trading in the gold market last is at 1779.40. I want to make a couple of comments here this morning. If we first of all take a look at the numbers on the left of the chart, they are the daily numbers that we have coming into today, which is the buy one level of 1787 and the buy two level of 1768. Right in between the buy one and buy two is 1781, which is a monthly buy one level. And what we have identified here is that the price has come down and activated the monthly buy one trigger of 1781. It activated earlier this morning at about 1:15 a.m. From last night at 9:45, it activated a bearish trend momentum, and the target pretty much was completed. The weekly mean and the daily buy one level of 1787 was completed. And as the AI tells you, do not go short between buy one and buy two, which are the daily signals, especially into that buy one monthly of 1781. Now, the probabilities revert on a trade mathematically where the sellers have between 10% and less chance of making a successful trade, even though the market can still have that 10% and come down. What you're going to see down here is reversions occurring, like here, where it reverted at 3:45 a.m., producing a monthly buy trigger of 1781. Automatically, the levels above become your targets when you enter a trade, regardless of whether they're daily, weekly, monthly, annually. And how you manage that trade depends upon your profile in terms of size. If you only have one contract, there's only so much that you can do. If you want to take the risk of adding two contracts, then I recommend, and I'll say it again, the first contract you take out the first $300, and then you trail the position to break even. Particularly, I'm referring to my traders in my Discord room. Over and over again, when you're day trading, this is the methodology. You go from neutral to the active signal. When executed, automatically you have the structure where you have your target above. If it's a buy trigger, your stop is the level below, and you can choose three different choices of stop. Yeah, you can choose a dollar stop. You can use a close stop on the end of the day. or you can use the most conservative one, which is a close below right away the trigger. So let me refer to the signal here. The signal this morning came in, the first one at about 11:30 p.m. at 1791.60. Let's say that you took the signal, and the reason for the signal was because the market came down. And I should say this. Let me go back here first to the to identifying the momentum a little earlier this morning, which is when the market went up to 1800, and it activated, it completed this pattern, this previous pattern, and it became active. On the second close below, after the pattern completion, the signal activated a bearish trend momentum, and automatically the targets were the levels below. The initial one is the weekly average. The second one is the buy one. So it activated both targets, intermediate and short term. You went neutral here upon the price reaching that target. It activated another buy signal because after the price came down, it closed above it using the 15-minute bar. You know, this is a very methodical strategy process that is systematic, and you know, as boring as it may be, this is the way that you trade the VCPMI. Don't deviate from the methodology, because then you're trading off the seat of your pants, just like everybody else. Discipline is extremely important, and the patience to follow the algorithm. The methodology I'm teaching you here, I teach you traders in my trading room over and over again. That doesn't change. What changes is where you do it from, depending upon the market being at the extreme below the mean or above the mean. So when you talk about the fundamentals of the market, all this chatter that we hear about the squeeze, the squeeze, the squeeze, the Reddit group, I believe it's got nothing to do with the market. And if you begin to listen to that chatter, you're going to get slaughtered. If you're a trader, you know what to do. When the headline hits the front page of the internet, it's time to take profits. It's time to sell. We're dealing with a lot of other elements right now that, as a trader, you know, we never had to deal with before, and that is primarily, obviously, the technology that we have, the internet. And for most traders that are new in this business, let me warn you, do not follow the herd. You're going to get slaughtered. And, you know, as a coach, as a teacher, as a mentor, even as a trader, I have to say to myself exactly the same thing that I'm sharing with you here. Because If you take a look just at what's happened here in the gold market or what's happened in the silver market, how do you justify all of this chatter about this squeeze, about the short of supplies, and the market is down 14 cents? What I'm trying to show you is that the sentiment of the market provides the juice for traders like myself, for large traders that understand the dynamics of supply and demand, that understand the dynamics of the market, making the difference between the fundamental, identifying the chatter, identifying the extreme levels of sentiment where you can trade profitably, consistently against that sentiment. Being a trader doesn't mean that you listen to the chatter or you get emotionally involved or you listen to anybody else. And what I'm trying to teach my traders, my subscribers here in my private coaching trading room, is that you want to use this VCPMI as a guide for you to make your decisions. It gives you the data for you to follow the methodology systematically, methodically, and what will make the difference is your application emotionally. So, coming back to how do we trade this, right? Well, there are a lot of bulls. I get a lot of people that are uh, very frustrated, including myself, because of this anomaly, okay, that we have, where the cash market continues to show tremendous tightness. You can't buy physical gold without having to pay a huge premium. So, the cash market really has some issues about supply. And obviously, the anomaly is that the paper market, meaning the futures markets, the contracts that we're trading here, the shares, the gold mining shares, the securities, are completely doing the opposite of what they should be doing. What everybody else is expecting them to do. So, why I'm bringing this out in this segment is because I want to point out to you what a contrarian market move represents. The market is doing exactly the opposite of what everybody expects. And that's a contrarian sentiment. The market knows that there are weak buyers, that there is a sentiment based upon rumors, based upon the internet, based upon this Reddit group, based upon this Wall Street bets, now new entity that has come into the market that is completely distorting the actual real flow of the market because they are creating a pump and dump mentality. as a trader, that is pretty much what I am seeing these people become, or this sentiment that we're looking at, which is contrary to what they're saying. That there is a shortage, that there is a shortage, that there is a short squeeze. Everywhere you look on the internet now, there are people commenting on the short squeeze. And where are we now? Silver is down 12 cents, ladies and gentlemen. I hope that you see my point, that you do not use the chatter. You do not follow the herd. If you do, you're going to get slaughtered. Let's come back here to the market and talk about how we make money trading the VCPMI in this kind of an environment. The artificial intelligence identifies the levels of the extreme levels of the supply and demand that is being traded. For in this case, we're taking a look at a day trading session. And so we look at the day trading structure. And we incorporate, obviously, the weekly, which is the intermediate, and the monthly, which is the long term for trading purposes. And what we can see here is that the market came down initially at about 5:30 a.m. to a low of 1776.80, which is below the 1781 level monthly trigger, the 1787 level. Even if we go back to when the market closed, it was trading below the average of 1800. It went up briefly at about 5:30, 5:30, and reverted back down, activating a bearish trend momentum. Came down to make this low of 1793 from 97.80, and then reverted back up again to test that average daily at about 9:45 p.m. Could not get through it, reverted back down again, and came down and tested the average price for the session. Not only the average price, but it came down and tested the buy one level of 1787. And not only did it test, but it activated a buy trigger. The first time it comes down, it meets the target, it goes neutral. On the close, using the 15-minute bar, if it closes above, it's a buy trigger. Automatically, you put your stop below and your target above, whether it's daily or the weekly levels, become your targets. So this signal here activated a buy from 85, and 87 was completed, 89 was completed. For the purposes of my traders here that have been with me for a long time, when you're day trading, you have this information already. In fact, you don't need to wait for me. If it's 4 o'clock in the morning or 3:45 and you're up, you're trading, the market closes above, you go long 85.20, your stop is the level below automatically, and you choose what stop risk you want to manage. You want to go into the trade knowing exactly what you want to do. Whether you want to stop below on the close right away, whether you want a conservative stop, a dollar stop, or an aggressive stop. When you enter in the trade, you want to define whether you're an aggressive trader or a conservative trader. The aggressive trader waits for the close. The conservative trader waits for the close. The aggressive trader buys the opening after the confirmation. So what you see here is the market trading in this range several times, and it gave you the opportunity to trade this market. If you want to trade this market, this is the structure for the day. So now we're finding ourselves where we are right now at 1777, which is trading below the monthly level, but it has come down into a 50% Fibonacci retracement again to test this level again. And this Fibonacci retracement is basically the retracement that we made from the low of 1450.90 to the high of 2089 made in August. And what you're looking at here is basically a consolidation, a corrective pattern down into that 50% level that we are testing again today. We made a low on February 19th of 1759. And this is a secondary test of that previous low. But what I want to point out to you again is where the price is doing this. It's in blue. Monthly, daily, right below we have the weekly. And so what this means from a mathematical point of view, the AI is telling you that this is a high probability area where we can find and expect buyers to show up. This is the extreme level below the mean, not only daily, weekly, but monthly. And so, in simple terms, the market is extremely oversold. In simple terms. In terms of trading the market, then obviously we go to the 15-minute bar and then we see the market action in relation to that signal. If you entered the trade early here by the close above, let's say 1787, the market went up to, pretty much 1793.90. Okay. So you had a profitable trade. The first thing that I recommend my traders is that depending upon your profile, if you do only one contract, I recommend the first $300 should be booked. Take your profit and call it a day. Making $300 in a matter of 10, 15 minutes is, most people don't do that. And this market here gives you the ability for you to do that consistently. If you don't get greedy, if you are systematic and you are disciplined, you follow the methodology that the VCPMI teaches you. You don't deviate from it. As boring as it is, and ladies and gentlemen, making money is very boring because you do the same thing over and over and over again as long as it works. When it doesn't work, that's when you wake up and you say, oh, what's wrong? Why am I losing money? But it's a systematic way of trading it. If you put your emotions aside, and if you're only doing one contract and the market goes up $350, take your profits. Go back to neutral. Wait for the next signal again until it happens, which it did. Again here at 3:45 a.m. Once again, it went long. Your stop is the level below. Your targets above were met again. You go neutral. You wait again for the signal. The market comes down below. It tells you do not go short at these levels, but wait for the reversion to unfold and a close above it. Here again, gave you an opportunity for aggressive traders to go back again above 1781 and sell 1787 by 6:30 a.m. So it's important for those traders that are following this for day trading that when you enter a trade, especially in a fast market like this where the volatility is tremendous, first of all you want to pay attention, or if you want to walk away, just put the limits on there. If you went to the trade, you can you put your stop below. If it closes below, you get out and you target above. Close the structure that it provides you for day trading, swing, or position trading. And again, if you have only one contract, there's only so much that you can do. Take the money as quickly as it comes. If you have multiple contracts, if you have two, you can sell the first one, take $300 and let the other one go, and you put your stop at trailing it at your break even, which is your initial target. Your initial entry point, your initial entry point becomes your trailing stop. And as the market begins to build equity, if it goes, and it continues to move, you keep building your trailing stop, locking in a profit. So if the market does come down below that, you're out. At least you're locking in, 50, $70, on whatever, the market gives you. But you want to have not only your trailing stop, but you also want to have your target above. That's the structure covered. That's the covered structure for the VCPMI when you enter a trade. When the signal is activated, you have the three choices of a stop, depending upon what you want to do in your profile, which has got to be clear. Okay. If you want to be conservative, use the close below. If you want to use a dollar stop, decide that you are willing to lose $1,000 like I do. Therefore, I don't worry about the market coming down or up or down or up or down, particularly when the market is in a volatile environment. You'll be getting stopped out constantly, like we did this morning. And if you didn't take your profits or trailed it, the market took it back and now you're in a loss. You got to monitor this market very closely. We're one of the comments here that I that I want to make, and I'll say this so that again I keep repeating myself over and over again, talking about the same thing, and that is talking about the way that you manage this volatility based on your profile. We are increasing the volatility factor tenfold from what we used to from what we were used to before. And you need to make those adjustments in your account, because it will make a difference. It's either going to wipe you out or, keep you in the game. You want to be in the game. You want to control your greed and be systematic about running this puppy, this process. The market is reverting, again from the average of 1789, which is the weekly, and we got up even the daily of 1800, and now we're finding ourselves, $30 below. For most people, this is a pretty big reversion. This is a pretty big, loss. And this is what I'm trying to make you aware of, it, that you can't go on the internet and listen to some of these idiots out there talking about the silver squeeze when they don't know nothing about the markets. How to trade it is what will make the difference. What difference is it to you as an audience that you listen to all these idiots talk about the short squeeze, but who are they showing you how to trade it? Specifically, methodically. So you got to be aware that what they are creating is a pump and dump mentality. And that can wipe you out, believe me, as a trader, really fast. So you got to separate yourself from those emotions, and you got to look at it objectively. And as a trader, it provides another level of liquidity to trade against. So we're down here in gold into a level that is extremely oversold. We've come down and activated the 50% Fibonacci retracement of 1771. And right below it, we have the buy 2 level daily of 1768. If we complete the target of 1768 and the market closes above 1771, that's your trigger point. That's your trigger point. I have some people asking me why. Well, number one, you're looking at a Fibonacci completion of a 50% Fibonacci, which is a highly reliable level where the market retraces back to its mean up to 50% retracement. In some cases, it can be 61.8% retracement at the extreme, which puts the price at about, says, 16.95. You're just using the Fibonacci retracement analysis. In between there, you can see that the VCPMI has given us a structure, a very specific structure weekly. The weekly average price is 17.89. The extreme level below that average price is 17.52. The extreme level number 2 below, or the 2-to-1 factor extreme level below the mean, is 17.22. Okay, this is the weekly numbers. And above, obviously, you're looking at the sell 1 weekly of 18.21, the sell 2 level of 18.58. On the left of the chart, you're looking at the daily numbers. And I put them on the same chart here because I want to see the relationship of the daily to the relationship, or I should say the momentum relationship. Let me just clarify here what I'm trying to say to you. The relationship of price harmonically aligned with the daily, weekly, and monthly is the highest, most optimal probability to identify a trigger point. When that trigger point is identified in price, it's identifying the momentum. When the algorithm identifies the trigger point, it identifies the momentum unfolding, resolving. And the price levels that you see is a consequence of the momentum that unfolds previously, prior, or prospectively. This price objective was activated by the previous momentum, which was activated by the bearish price momentum when the price came down below the average price. And so it's come down into the area in blue that I keep identifying for you, that is between 1787 and 1768 at the extreme below the mean. By making a law of 1768.90, we came down pretty close to 1768, which was the buy 2 weekly. Now, the buy 2 daily, the buy 2 daily is a 2-to-1 factor with a 90% relative implied volatility to the mean. And so the market has pushed the price up to 95% away from standard deviation. The buy 1 level is 90% relative implied volatility to the standard deviation of the average price of 50/50. So you're looking at the market in an area mathematically where the probabilities are very high that we're going to find buyers here. So we look for that. It tells you we don't want to sell into a strong probability area to find buyers, but we want to see the market confirm that prospective analysis by actually buyers coming into the market. And that means that we want to see green bars from here. We are in a synergy, high level of synergy, high probability mathematically that we are going to revert from here. So we wait patiently until the market confirms it or negates it, right? That's all we can do. That's all the market can do. If it confirms it, the next bar, we want it to be green. The close of the next bar. Remember, we use the 15-minute bar. If it closes below, do nothing. Just do nothing. Let the market go. Let it go to where it wants to go. And it could be that it wants to come down to 1752. But the VCPMI teaches you to be disciplined about following the signals that it provides you prospectively before the market opens. So what we want to see is buyers come in here. Again, we want to see green bars begin to unfold from here on the 15-minute bar. And if we get a close, for example, at the close of this bar in about 3 minutes, this bar here represents pretty much a bullish pattern because it pretty much satisfied, if you use a 10% margin of error and the low of 68.90 with a target of 68, that pretty much completes the pattern. What we're looking at is patterns unfolding, momentum patterns that we want to trade. That's pretty much what the VCPMI identifies. So for all intent and purposes, if it closes here above 68, that's a bullish pattern. If you want to be an aggressive trader, you can buy the opening on that pattern at the opening of the next bar. Conservative traders will wait for the close of that bar, of the next bar, to enter the market on a close above 1768. That's how specific the intelligence, the AI is. And as the robot, I'm waiting, for the close, and I'm ready to push the aggressive button or the conservative button if it closes above 1768 in 1 minute. This is the trade station radar screen and also the algorithm levels identified on the chart. And again, we're waiting to see the close of this bar. And closing above is bullish. If it closes below, you do nothing. No signal. It did close on the long side, so you can buy at the market right now. It closed up above the 8, so you can buy at the market if you're aggressive, or if you're conservative, you can wait the close of this bar at 8 o'clock and buy long if it closes above it. So that's how defined this is. For you as an aggressive trader, or you want to do an aggressive trade or a conservative trade, this is how you measure the risk on the trade. So aggressive traders actually bought the market at the close, at the opening of this bar, actually, which was 71.80 if you were aggressive. Conservative, you want to wait until the close above 68. And if it does close below 68, both aggressive and conservative traders can get out of the market and go neutral. If you want to use the close below, which is the most conservative stop. Now, you're at buy 2. Coming back to, again, the algorithm, the buy 2 level represents a 95% relative implied volatility to the mean. And the mean is 1800. So if it closes above this level, conservatively, it activates a 95% probability that the market momentum can take us to 1800. Now, in between, again, we have targets. 1781 is the monthly. 1787 is the next level daily of buy 1. So if it gives you a chance to get long from here, which is saying the market is extremely oversold, the close above 1768, you buy long, you put your stop below 68 conservatively, your targets above are defined. 1781, 1787, 1800. Depending upon your profile, it tells you exactly what to do. You as a self-directed trader need to make that choice depending upon how you manage the risk. This is what's important for you to understand whether I trade conservative or aggressive. That is your risk profile that you as a self-directed trader need to identify when you enter the trade. So for all intent and purposes, you could have executed, the aggressive and waiting for the close on the conservative. And this is how you lay into a multiple position. But what I'm teaching you here, please understand that this is how pretty much I interpret the AI behind the algorithm. in terms of identifying the directional move, the momentum. What we're talking about when you uh, pretty much want to define whether you're aggressive or conservative, that really is, again, up to your profile as a trader, how you want to manage that risk. And how you enter the position and how you manage that risk depends upon your current inventory, depends upon your balances, depends upon your cash balance, depends upon the big picture. So I make a point of knowing exactly what I want to do when I enter a trade, whether it's day traded, scalping, or positioning. And I truly, truly adhere to the discipline of applying the levels provided by the VCPMI. So again, you could have entered an aggressive trade and a conservative trade if you are doing multiple positions. So again, you have to define who you are, not just, is it conservative or is it aggressive? Know exactly what you want to do when you're day trading. You have to. There's no second guessing as far as I'm concerned. I don't never, well, I should say never, because never is never, but I adhere and I try to be disciplined about following the methodology. Define who you are, and that's how you manage the risk. Exactly. If you can, if you can only afford one contract, then obviously you want to wait for the conservative entry point. Um, if you can afford multiple contracts, then again, you might have entered one at the opening and one on the close if it gives you that signal. But if it doesn't, you got to be prepared to get out of both. It's more active trading management of the position. So just to reiterate here, what's happening here is that the signal, if activated from here, it's activating a buy trigger from a blue area, from a high probability area of a reversion unfolding. And when you look at the daily signals, then you can see where the reversion may unfold from and where it could go to, classifying it as a daily, weekly, or monthly targets. So if you enter, at 68 on the close, then 1781 becomes your first target. 1787 becomes your second, 1789 your third, up to 1800, it will complete this pattern. That's the pattern that we're trading. That's the structure that we're trading. And it looks like we're coming in with an active buy trigger, closing above it, 68, 71, 60. Now we're looking at a $3 risk on the conservative. And so you also want to measure how far the market closes from the entry point. And if it closes more than $300, just let it go. On the conservative trade, just let it go. Don't enter anymore, because your aggressive trade now is beginning to work. And the signal for the conservative trade is too much risk, too much from 68 to buy at 72.50. From 68, that's a $450 risk. So it's too much for my taste. Anything above $300, I let it go. There's no reason to chase it. Now, particularly if you are carrying a core portfolio, you got to understand that if you miss the trade on the buy side, you don't miss anything, because you're carrying a core portfolio that, if you've been following what I've been saying here, is build a core portfolio, so that if you miss a day trade, you are not missing the move. You're still building equity. And that's the way I look at it. This is the way that I manage my portfolio. This is the way that I'm using the VCPMI. And this is the way that I'm coaching and teaching my subscribers and my traders here in my private trading room. Hold on to your long. You got your targets in place. Enjoy the day, my friends. Lunch is on me. Have a great day. We'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.